However, the problem, okay, is that GDP as an indicator is actually a lagging indicator. It's telling us what's happened. It's telling us what's happened to the economy in the past, which is okay, but a lot of the time you're going to get a lot of the buy the rumor, sell the facts type type of behavior in the markets, right? So as traders, we want a way of predicting future GDP growth, all right, so that we're ahead of the retail traders. We want to be where the professionals are. If we just trade based on what the GDP is, we may make money some of the time, but the problem is we're getting to the party late. The professional traders have already been in that trade for the last 6 months, for the last 12 months. So we need a way of being able to predict where GDP is going. And that's what we're going to discuss later on in this webinar. Now, we talked about the three major economies, all right, the three major ones in the world. One of them is the US, right, and that's the world's largest economy. The economy is worth about 15 trillion per year. And this is then followed by China and then the Eurozone. So if you've ever heard people say, when the US sneezes, the rest of the world catches a cold, that's exactly why. Because the US is what is the world's largest economy. So if it's in good shape, then global growth is also generally going to be in good shape. You see, if the US economy is healthy, consumers are more likely to spend more, which in turn is going to then support company earnings, which effectively results in the S&P 500 rallying, all right? So, which is positive for risk and positive for long growth currencies. Now, the reason that I say that is it's important to understand that if the S&P just rallies, it doesn't mean necessarily that the US dollar is going to rally. See, the S&P is kind of like a proxy for risk, if you like. So the currencies that are going to benefit the most from the S&P 500 are going to be those perceived growth currencies, which is why back in sort of 2009, 2008, when we're coming out of the crisis and everybody thought the US were going to stay there longer than others, you would see with the S&P 500 rallying, you'd see like the Australian dollar rallying or the dollar CAD falling off a cliff, for example, because people were more interested in the growth currencies. Does that make sense? But essentially, the GDP is correlated to the S&P 500. So if the GDP is up, S&P 500 is going to be up. So if we have an idea of where the US GDP is going to be in the next 6 to 12 months, we know where the S&P 500 will be, correct? And therefore, we will know which FX trades to place. Does everybody follow that? So the key question here, the million-dollar question is, how do we therefore predict US GDP? Without looking at the screen, close your eyes. How do you think we do that? Okay, no takers. Well, the answer is the one economic indicator, the one report that seems to be forward-looking in 80% of the time, as I'll show you later. So 80% of the time is forward-looking, is the ISM Manufacturing PMI. Now, the ISM Manufacturing PMI is a survey of all the manufacturing managers from 300 manufacturing businesses. Now, the report's equally distributed, all right, and it covers 5 main areas. So new orders, production, employment, deliveries, and inventory. And as I said earlier, in the beginning, you don't need to be so concerned with each of the, the individual areas. You might be interested later on to delve deeper into things because obviously if people are holding less inventory, they're a little bit more negative about what's going on later on in the year. If they're holding more inventory, then they're potentially they're more positive. So they all have, each of these different areas you can attach different meanings to them depending where you are in the overall economic cycle, all right? But ultimately, it's a comprehensive report that covers the major areas of the US economy. Has anybody ever looked at, do you know what the ISM is? Or have you seen it on Forex Factory? See, it's important to understand that a lot of the time, the numbers that come out aren't the individual numbers aren't important. What's important is the trend, and it's the trend of numbers that's going to help you predict where the longer term moves are going to manifest themselves. You know, whether you're going to be looking to go short some of the growth currencies or whether you want to be going long. And a basic, sort of very generic basic guide to this is with the ISM manufacturing PMI, if the ISM is above 50 and growing, as in if it's trending up and up and up, so 50 one month, 51 the next, 52 the next, etc., we're going to have a solid long bias. So we're going to look for areas to exploit our idea that there's going to be good global growth by exploiting growth currencies. All right. If the ISM is above 50 and slowing, we're still going to be long. Our bias is still long, but we're going to be a little bit more cautious. All right. And that's sort of where we're at right now. And I'll talk about that later. All right. But at the moment, what's been going on with the ISM, if you look back over the last 3 months, is it's been above 50, but it's been slowing a little bit. So we're cautious. We're still long, but we're cautious right now. If the ISM's below 50 and slowing, then we're going to have a solid short bias. And if the ISM is below 50 and growing, then we're going to be short, but again, we're going to be cautious, right? Much like we are with the, if the ISM's above 50 but slowing. So what's important to understand here is when you're looking at these things, you need to appreciate that it's not just one number in isolation that is going to have a big impact on where your swing trades, where your position trades are going to go. It's not one number in isolation. It's a series of numbers. It's the pattern for where the market is going. Is everybody still with me? You all still awake? You see, I know, I know everybody wants to look at the technicals. Everybody's very, very interested in making sure that they understand the best chart patterns and all of this good stuff. But I can assure you, it's this stuff right here. It's the fundamentals that's really going to take your trading onto the next level. Now, particularly for those of you with full-time jobs, for those of you that can't sit in front of your screen all day long and take advantage of, you know, the volatility, day-to-day volatility in the markets, this stuff here is what's going to make you profitable in the long run. And I know it sounds like a chore and it sounds so much like hard work, but I can't stress enough. This is what you need to be looking at. So if you're all asleep, please wake up. All right, so we told you that the ISM manufacturing PMI is a leading indicator of what US GDP and hence the S&P 500 will be doing in the next 6 to 12 months' time. And that is with an 80% certainty. All right, and that's basically over the last 50 years, there have been studies done and where the ISM can predict it with 80% certainty. So if the ISM predicts it's going to be up in 6 to 12 months' time, it will be up. Right, and then hence global growth currencies will also be up. So here's an example. In February 2009, right, just after the crisis, the housing crisis, if you can all remember back that far, the ISM manufacturing PMI bottomed. All right, it started to print more positive numbers, if you like. So it was in that phase where it was still negative, but it was growing. All right, so it bottomed. March 2009, the S&P 500 also bottoms miraculously. In September 2009, ISM manufacturing PMI climbs above 50, signaling expansion. 6 months later, March 2010, the S&P's climbed from 996 to 1180. The Australian dollar, right, which was one of the growth currencies back then, quite a good proxy for risk, had rallied 1,000 pips from 0.8200 to 0.9200.